unstoppable of economy today and tomorrow. As the global economy continues to experience turbulence, let's look at the possible scenarios together with industry experts. Please welcome on stage our moderator, Hormoz Faryar, Head of Institutional Sales at ADSS. Hormoz, the floor is yours.
Thank you. Hi everyone, so we've got an economy panel today to discuss the future and predicting the future. The most difficult thing in the world really, to predict what's happened, how things that happen impact the future. So I'm going to start by letting each person here introduce themselves and what they're working on, etc. for just a minute or so. Wael, if we start with you.
Hello everyone, thank you for attending. I'm Wael Makarem, Senior Market Strategist at Exness, and it's a pleasure being here. So, yep, this is it.
Hi, I'm Journey. I started in FX in 1997. I was the founder and CEO of FXCM, and today I'm CEO of Strategist.
Hello everybody. Thank you for having me. My name is Ahmed Allam. I'm a financial expert at His Highness Court, and we are working on financial fraud investigation, company liquidation.
Thank you. Yeah, I just realized these two guys, they represent something big each. So in terms of like one of the biggest brokers ever here, Drew built one of the biggest brokers ever, FXCM, and the ruler of Dubai built one of the best cities ever. so they represent something there. So I'm going to start with the first question. So which regions in the world are doing kind of well in terms of economy and the recovery from COVID? Sort of maybe cities or states or regions. If we start with you,
Yeah, sure. Actually, we've been in 2 interesting years since we came out of COVID, and definitely the remarkable recovery back in 2021 that we witnessed in the United States was insane. And we have to separate what happened between 2021 and 2022. So post-COVID, all central banks were doing an easy policy. They were trying to support the economies and doing all what's needed. Even governments, they jumped in on looser fiscal policies. So this is what they were trying to do back in 2020, 2021. We went into 2022 and inflation kicked off. So we've seen a complete twist in what we've been seeing. So central banks went into more tightening. All interest rates went significantly higher the past year. And we always been talking about possible recession, possible slowdown. So this created a bit of a dilemma on where we could be heading in 2023. We've heard a lot of expectations on long recession, let's call it. But if we just want to highlight the possibility, we started seeing better numbers. Latest the GDP from China for the 4th quarter came out at 0% versus expectation of negative 0.8. This is a bit encouraging. Europe is doing a little bit better with better weather now, so a bit of more optimism. The United States, I still feel the money that was pumped by the Federal Reserve, let's call it that way, and the stimulus package that were done by administrations, I believe there is still enough to sustain the economy. The drop in the 1st and 2nd quarter, I believe they were technical, and we're still going to see a little bit of growth. I'm a bit optimistic going into 2023, especially if really inflation figures start to calm down, though we're in a bit of a tight situation. Everyone is looking for China's reopen as an opportunity. We've seen a big rally in Chinese equities for the past couple of weeks. European indices are significantly higher since the beginning of the year. DAX was outperforming. So there are a couple of opportunities. We can't just rule out what could happen literally in 2023. It's becoming very hard to just look on the long term a little. We can definitely, with a certain precision or certain probability, to expect where policies could be going. But we're living in a day where every decision is mattering and it's affecting markets.
I'll come back to you about which cities you believe as well. Drew, what's your thoughts on regions? And you're based in Florida, in the US, so...
Yeah, I mean, just like we said before, I think the entire world exists on this, is doing better than it should be doing. Basically, exists on this puffy cloud of easy money, right? That it's going to take a very long time to melt the puffy cloud, right? And so it's not going to, people think, oh, it's going to be a recession soon. It's going to take a long time for all that financial support to go away. But it's going away, right? And I think that there is long-term, when I say long-term, next few years, asset prices should still continue to decline as we're taking money out of the system. And we're going to be taking trillions of dollars, just like we added trillions of dollars. We're just going to take them out slower, so the descent is not going to be fast. But we're going to take, I think asset prices are going to decline. So I think, in general, that most consumers are doing better than they should be still. And that's, I think, going to continue to be the case because, like you were saying before, I think the stimulus was so much that it's not going to disappear overnight. But I don't think the obvious winners, right, longer term, everybody knows the Middle East, the oil-producing regions of the Middle East, right? Because oil prices are going to be, obviously it's going to stay up here for a while, especially as China recovers from COVID. It's going to be even more, right? There's going to be pockets everywhere. There are going to be better pockets in other places. Obviously, Dubai is an extreme example, right, of something that's going to do amazing for the next few years. But like in the United States, Florida, Texas, places like that are doing awesome. Right now, everyone's doing awesome in the United States, but in the next year or two, most probably will not, right? Where places like Florida will do, you can see those demand is very resilient, right? In places like New York, most likely not.
Yeah, sounds like we're going from long COVID to long recession.
Actually, this is what everyone is a bit expecting due to high interest rates and all that usually shouldn't support. But I believe what's happening more is that everyone is being pessimistic. This sentiment is just scrolling over and over, and it's trying to push everything down. Though the latest survey with some of the heads, more than 60% of them, they believe they have no need to just, for example, let off people. 80% they believe they're just gonna keep more of a maybe cautious tone, but they're not as pessimistic as they were in mid-2022. So we hope things can get better.
In fact, our world had a very exceptional period during the last 3 years. I don't remember that the world has had such challenges in the modern history, starting from the climate change, passing by the COVID pandemic. Then we moved to the military conflict between superpower, and it's ended up by the economic crisis. So all of this integration of the challenges which the world had result in decline of the global GDP. If we screen the global GDP between 2020 till 2022, we'll find that GDP declined dramatically in 2020 by -3%. Then it started to go up back again by 6%. Then in 2022, the GDP growth rate for the world declined by 3.2% compared to the previous year. And all of the forecasts refer that the global GDP in the 2023 will reach between 1.5, 1.6. United States itself, it's expected to have a GDP growth rate of 1%. The Eurozone expected to have a GDP of 0%. On the other side, the emerging market and China will have an expected GDP growth rate between 3 and 4%.
These are very low, right? Low
compared to
lower than ever, maybe.
Exactly. It's this recession or this slowdown of the economy is a result of many factors. One of them is the tightening monetary policy applied by the central bank and Federal Reserve. The high cost of borrowing, it's affecting deeply on the performance of the economy. On the other side, also the geopolitical situation. So all of these factors integrate together to slow down the economy during the coming year, which may extend to till 2024.
So where would be your favorite region globally in terms of economy? It's difficult, I know, but
Like I have an eye on a couple of things. If you just look at the latest, maybe like we're looking for China, some of the tech space. If we the crackdowns already took place before, and even for the economy to just try to restand, the People Bank of China has a lot of room to do to go. So this could be supportive for the stock market in general, but. There are after the drawdowns that took place last year, there are plenty of opportunities that you can really invest on, but it depends on the horizon, what you're expecting or where you could be leveraging. So this is.
Drew, other than Texas and Miami.
To connect to the audience, like if you look at Middle East is obviously the obvious trade that everyone's going along with, right? Going along with this region because for the obvious reasons that oil prices are going to be higher for a few more years, that the mixture of the regulatory environment here plus the money that's here, you can't beat it as a short-term investment. I think if you look at, for brokers who are looking for less crowded, right, that's not Middle East, I think if you look the next 10 years, Latin America should be everyone's number one choice. And I'll tell you why, if you look at geopolitics, that you were saying, like that's going to change a lot of things. Both Europe and the U.S. realize if there's a war, if the same thing happened between China and Taiwan, what just happened in Ukraine and Russia, the entire global economy is completely affected, right? Like everybody, 75% of semiconductors are in Taiwan. The supply chain of every major company is dependent on China. And I think if you're a U.S. company, you're looking to Latin America now. If you can't go onshore back in the States for practical reasons of regulatory and labor costs, the nearshoring that's going to happen is going to be Mexico, it's going to be Brazil, it's going to be places where are geopolitically very friendly, right, are near, closer. You know, that I think there's going to be a big move, sort of like Hong Kong wealth migrates to Singapore, and if you look at like the shifts are real, but I would say there's lots of shifts in lots of places. Latin America is probably going to be the biggest beneficiary of that.
So South America, Central America, the only threat there I can think of is the fact that they're going a bit crazy socialist, some of the governments there, like Venezuela, Argentina. I think there's a few others there.
Yeah, you're going to have to pick your pockets, and I think Mexico is probably the safest choice, and closer to the States are probably the nearshoring is going to be the best there. And if you look at, already can see it, the majority of immigrants that are trying to get into the United States from Latin America, the migration, is not Mexico. It's people that are coming to Mexico, and then Mexico is a transit point, because the amount of jobs going to Mexico is pretty high, right, because of that repositioning. So I think as a long-term trend, I think Latin America is going to be a big beneficiary. So if you look at like the first 10 years of the 2000s, like FXM had 50% of its business in China. It just was where the middle class was growing the biggest, right? But if I would say that 10 years from now, I think Latin America is going to be the biggest beneficiary of thousands of plants for those reasons. And uneven, like you said, because of governments, right? But there's going to be a reward for those who stay in the center.
Amazing. Ahmed, what do you think?
In fact, actually, the coming years, it's a time for the emerging markets, and plus the time for the commodity. In fact, we saw a booming in year 2021 for the fintech, and we saw what happened for the fintech company in general in 2022 with a dramatic decline of more than 60% of its market value. Now it's time for the commodities. It's time for the stock market in the emerging markets, especially in the Middle East and North Africa. I think also the China market had suffered a lot, but in the coming or in the nearest future, it will recover what it lost for all of these 2 or 3 years after the COVID pandemic. So all of, and plus we saw during the last year the only assets which did not go with the flow in the declining process was the private equity and the cash. I mean by the cash is the US dollar. The US dollar succeed to cross the economic crisis in 2022, or the all the declining stages happened in 2022 in a proper way. But I think it reached its peak, and it's time to move to other category of assets, the commodity, the gold, and the other markets such as the emerging market and MENA region, Middle East and North Africa.
Great. So brings me to the next question, which is, what is the best asset class, in your opinion, for this year? What's the asset class that might perform better? If we're going to have more inflation or a longer term inflation, maybe gold, but then we might have less inflation, so maybe gold won't do that well. So what is the asset class you would say is safer?
It's not about the safer, but like following what happened during 2022 with all the drops in the stock markets globally. If you look at the United States in general, usually 73% of the time it was the next year of the S&P was a positive year of return. If you're looking for like a possible return on an investment, especially if you're investing for longer and not just going for some short terms. Actually, the tricky question is going to be whether inflation is going to look more sticky, how the central banks will do going the second quarter onwards. Each one has several scenarios. So if this happens, then you have to go to these asset classes. If the other thing happens, the other way around. So if interest rates
is the stock market overvalued in your opinion then, or
no, actually,
after all
like,
this money?
It's still, let's not say it's heavily undervalued. There are some good opportunities, but definitely the collapse or the drops that happened in 2022 were much needed. We were at a time in 2021, just whatever you buy, you can just see a significant percentage of return on the upside. So 2022 was crucial for stuff to start to reevaluate. And now investors are looking more on the numbers to see where we could be going. But like, it all depends on where policy is going to head during the second quarter onwards. So the Federal Reserve is going to stop at 5%, and the Federal Reserve is going to go to 5.5%, it's going to hit 6%. How asset classes will perform? I believe we're not going to stay at 5%, we're going to go higher. Service inflation will tend to be more sticky. If something happens on the energy side, we're going to see another round of inflation. All countries around the world, if we just talk about good economies, they're suffering with the labor side, tight supply on the labor markets. So all these could support higher interest rates for longer. Higher interest rates for longer will definitely create some pressure on stocks. We have a new alternative after going for TINA for 2 years. In 2021, there was no alternative in the stock market. Bonds weren't yielding anything. Now you have an alternative. So if we look at the market, there are plenty of ways to go through, but all depends on where interest rates could be settling second quarter onwards.
I think interest rates going higher than expected. If it goes 5-6%, it looks bad. Miami property might be really bad, huh? I mean,
so if you look at asset class, you can't. It's super hard to make that decision. It's regional, and you can't do it by asset class. So if you look at, I agree with what you said. Interest rates are going up, higher for longer. That's just negative across the board for every asset. So if you said, globally speaking, right, if you don't look at any regional differences, assets over the next 2 years should decline, and decline a lot. If you look at the line of the last 10 years where we are, we have a lot to go down. For real estate, stocks, and everything else. No way it doesn't get there if rates stay high.
so if I told you 6% interest rates,
if you said 6% interest rates, you're talking about 20% down stocks, 20% down real estate, easy, right? Now, what I would say is, that's globally, right? But and even commodities get hit. Everything gets hit. Right? 6% is the world has not operated at 2% in 14 years, much less at 6%. No one knows how to do 6%. Those people are retired already, right? So I think now where I think if you look at asset class to invest is. If it's tied to wealth, like in Dubai, as an example, or in a place like where people are moving to artificially because of all the issues that are going on in the world, right? Then real estate here is not going to decline. Real estate in Miami overall should hold up a lot better than real estate in New York, right? But so if I look at it's not an asset class really that's going to stay, because all asset classes should decline, but I think there's going to be regions that are going to do amazing, or sustain themselves at least.
Ahmed, it's 5-6% interest rates. UAE is also pegged to the dollar here.
Actually, it's so tricky question, by the way. As you know, that it's so difficult to predict or to determine the appropriate assets to invest in for the long term. But if we're talking about within the nearest future, based on the performance of the stock market during the last year, and also the high interest rate applied by the Federal Reserve and other central banks, so it's well known that once there is a decline in the stock market, the performance of the commodity is going much better. So in the coming or in the nearest future, the performance of the commodity will be much better compared to the other asset classes. Also, the bonds based on the high interest rate, especially the Federal Reserve will not keep continuing increasing the interest rate till much longer time. He has limits to cut these rate hikes. He cannot exceed it based on the performance of the economy and the suffering of the, however, the global economy and the United States economy. So the bonds, the commodities, the gold specifically, if we target the emerging market and Middle East and North Africa market is so attractive to invest in if you are searching for the stock market.
Yeah, so if we have, so what is the interest rate now in the US? What's the...
Actually, now, like, what's expected is to go for 2 more interest rate hikes by 25 basis points to reaching 5. Now it's 4.3, 4.50. So this is what we're aiming. The market is pricing now by 91% probability to raise interest rates by 25 basis points in the meeting coming early Feb, 1st of Feb, and another 25 basis points to come in March. So
we'll get to
5.
5.
4.75 to 5. This is what the market is expected. However, the Fed officials recently, they've been saying this again and again. The market shouldn't be underestimating what the Fed could do when it comes to interest rates.
So you think they might go to 6%?
Actually, what I believe this year, it's going to be the year of 25 basis points. Definitely they want to, what was proven with the recent actions by central banks, that they are more happy dealing with slower growth or recessions than dealing with inflation. So what they're trying to do is to fight inflation, make sure inflation is going to go back to normal levels, and then later on, if something happens on the economy, whether it's a recession, it's a slowdown, they can deal with it. And it was very clear with the talks different times from Powell or other Fed officials. Going into this year, it's very critical, though. Imagine CPI index, if we just look at the index, not at the change. 2 years back, it was around 250, 256. If we had to increase by 2%, just do the math to see how many years it would take you to go to an index of 296. Currently, we are at 296. So the same basket that used to cost you this is now costing you this. Even though if it's not going higher, it's just steady at 296. But it took at least 6 years of, maybe you can call it spending. So you could have been spending for 6 years with inflation staying at 2% to reach this level of inflation. So all this is being deducted from what consumers can pay from their disposable income. And earnings are trying to catch up a little. They're still a bit far away. If you look at the real earnings, they weren't much doing with inflation. So this is what puts the Fed at a very critical.
Yeah, so we're going to reach 5-6% interest rates by the Fed and staying there maybe a year, 2 years, you never know.
Actually, like staying a year or 2 years, you have to see how the economy will react. Definitely, there is no preset course. All ECB, Federal Reserve, Bank of England, most of them, they're adapted dependent.
And this
So they're
scenario
not
is
going
going
to
to be tough for gold or anything like that.
It's gonna. I have a different concept. There should be at a time. You need to bring back people to the labor force. You can't stay just with this tight market. Participation rate didn't recover after COVID. Unemployment rate is staying at 3.5%. It's not only the US. Look at the UK. Look at sometimes some places in Europe. You need to do something to force people to go back to the labor force. Else you're going to have this continuation and problem going on and going on. Companies will not keep on raising their earnings, and raising earnings more is going to bring more demand, and this is going to be the norm of having inflated numbers everywhere.
Drew,
So,
what's your thoughts on this?
So, I mean, I think, like, to go back to asset class and all that stuff, and connect it to, you know, the kind of the brokers in the room, you have to go back to a pre-financial crisis world, right? Of how the world operated before rates went to zero, right? So if you said, how the world went, what did the world do before everything was zero and we were like in fantasy land? You know, the carry trade was the biggest component of FX trading institutionally. It was actually a huge component of it in a retail business. Like FXCM prior to financial crisis, 35% of revenue was interest rate related, right? And I think that if you looked at brokers a year or two from now, all are going to be, you know, most brokers today took the swaps out, right? Make it easier, swaps don't mean anything. Everyone's going to put that back. The demand is for the carry trade is going to be very high, right? It's going to change the business model of a lot of people having a hedge, because that stuff you cannot hedge, right? So if you look at the real thing, a world with really high interest rates is going to have a different consumer. And it was said in a panel, you know, prior to this, was like, you know, this whole crypto universe that just left crypto, right? Because it was all the yield earning stuff in crypto was basically a Ponzi scheme, right? And so the trading was not, but the yield earning segment was very much a Ponzi scheme. And if you look at that in FX, it's real. It's not risk-free, and the dollar yen moves, so it's not simple like, okay, you go 3 times dollar yen, and now you make 15% a year. There is the rate of dollar yen moves. You can make more or less depending on that, but it's a real yield earning thing, and that's going to attract. That is going to be, I think, the asset class in the next few years. I think that's going to be a huge business. That business, if you're in this industry after 2008, you don't even remember that this existed, right? But before 2008, this was a massive business, you know. And I think that business is coming back, and that business, its effect is it's going to suck money out, right? It's essentially just the trading of short-term interest rates, right? It's just the shortest-term bonds there are, right? And so you're sucking money out of every other risk asset.
You remember what the interest rate was when you started FXCM?
It was dollars. It was 6.5%.
6.5% interest rate.
Overnight.
And it had come down probably, or it came from like 10.
Yeah, so obviously in the 80s it was 10, right? In the early 80s, but I mean it was meandering 90s, 2000s, right? And like the mid-single digits, right, went down a little bit, like 3 or 4%. But no one ever saw in lifetime zero, and I think zero changed the world. And we had zero for 14 years. We don't even know, right, what it's going to do, really, right? Like 3 years of real interest rates. I don't think the world is ready. Like governments are not ready. Like you were saying, like get back in the labor force. We're able to keep people out of the labor force because all the welfare that we've been giving, we printed out of thin air, and without consequence.
Well, I know what happened. So I removed a bowl of candy from a birthday party once from the kids, and it became riots. So when they're used to candy, they're going to come for it. So if low interest rates are like sugar, it's going to cause a lot of problems when you take it away from people.
Yeah, this is why obviously nobody wants to, because you don't want democracies don't want the votes against, and dictatorships don't want the riots, you know, and I think that that's the issue that you have, but at the same time, interest rates are going to force that issue. It's going to be unaffordable to do it. There is coming a time where that is just not tenable.
Are we going to get global riots, Ahmed?
Actually, your discussion will push me to just refer to some conceptual idea about the inflation and the role of the central bank and the Federal Reserve. As all of us know that the Federal Reserve main target is to promote the safe and strong economy by maintaining a healthy employment rate, reasonable interest rate, and acceptable inflation rate. During the last year, the central bank and the Federal Reserve had applied an easy monetary policy by increasing the cash flow and the circulation and decreasing the interest rate to the minimum level. This policy succeeded to push the economy to a high growth rate. But on the other side, there was a negative result of this policy, and we experienced a high level of inflation we did not experience for multi-decades. So the situation reminds us, or bringing it back to our memory, the Volcker shock in 1980 in the United States, which referred to the tight monetary policy applied by the Paul Volcker, who was the chairman of the Federal Reserve in 1980, to control and maintain the inflation rate to an acceptable level. And based on what he did, the economy go on slowing down, and the unemployment rate went high. However, at the end, he succeeded to push the economy to go back to the growth.
That was late 80s, right?
1980s, 1990s. And
That's
after...
when we had riots in Los Angeles, wasn't it?
Yeah. So actually, the Federal Reserve at the moment had 7 rate hikes between March and December 2022. He pushed the interest rate from 0.5% to 4.5%. And the last report, or last job report for the United States, revealed that the number of jobs for till December 2022 has reached about 230,000 new jobs, which more than the expectation. And this gives an indication that the Federal Reserve will slow down his tight monetary policy he is applying. So it's expected that the Federal Reserve may be reached 5.5% within 2023, and we can see again slowing down of the interest rate by the first quarter of 2024.
Okay, so I want to cover quickly, we have 2 asset classes, oil and Bitcoin. That's an asset class, right? So we'll get to that. But
To some.
what did you say?
To some.
Sorry?
To some, it's an asset class.
Yeah,
For others,
to young
just
people.
Actually, for everything there is a risk. There is when you're looking for a reward, there is certain risk you want to take. For Bitcoin itself, the wallets holding one Bitcoin, at least they're around 1 million, approaching 1 million. So this is something. To me, it's all a liquidity game when it comes to crypto. It's clear that it's a liquidity game. So as long as liquidity is getting lower, price is going to go higher, and the other way around. But you always need this driver for speculation and all that. When it comes to the industry itself, it passed through a couple of hits this year: FTX, Luna, and all other yield projects. So it's definitely an industry thing. When it comes to, if we look at the impact of what's happening in policies to this asset class, to Bitcoin price, definitely easier policies, or at least a twist, or at least going on hold for interest rates could be good for risky investments, whether they're stocks, whether they're crypto. You call it, you're going to consider Bitcoin as a class, which is
Crypto. So crypto is in a high interest rate environment. Drew. That can't go anywhere either. We're going to have 5-6%.
No, but I think crypto is one of those things that it's an anomaly. So if you looked at post-World War II, probably 100 countries in the world ran on the black market dollars. Today, probably down to 40. But we still have a lot of countries that run on the black market dollar, right? Where the black market dollar is, and I'm not talking illegal transactions, like drugs or something. This is just, if I had to save money, I save it in US dollars. Because I have a toilet paper currency domestically, right? And that's a lot of people. And what happened in the last 20 years is regulations in the US and Europe have basically have made the black market dollar essentially almost impossible to be used, right? Impossible for a non-US resident to open a US bank account, you know.
So the only way for them is Bitcoin, essentially, to save money kind of related to dollars or something.
And I think it's a transit point to go to dollars, or a way to get out, a way to pay. I think crypto is here to stay because it's a new black market dollar, right? So for that perspective, it's very real. If you look from a perspective of, is an asset class going to go, like, so, you know, it was a bubble asset class when interest rates were zero. People said, well, why not bet on whatever, who cares, right? And it picked up momentum, and it's going to go to the moon. But when I can sit at risk-free at 6%, right? Lots of money is just going to sit there at risk-free at 6%. And if take a little bit of risk at 8%, take a little more risk at 10%, why would I bet my money, right? When risk-free was zero, so much money had to go somewhere else. I don't think people understand the amounts, right, that crowded out, right? That, so all risky asset classes obviously came down a lot in 22, still have ways to go, and are not going to go right back up because the world of rates is not going to allow it. But I think crypto has that place that it's sort of like, you know, nothing to do with economics,
yeah, even if
more
you
to
ban
do with
it,
regulation.
people would want to keep it as a saving.
Right.
Ahmed, so you guys, yeah, you know a lot about cryptos. I know you studied it. You guys probably investigate crypto firms, probably. But so, what's your thoughts on that? Like,
Once we talk about crypto, we have to clarify some facts related to the cryptocurrency. At the moment, there is more than 12,000 types of cryptocurrencies with a market cap more than $1 trillion. It reached more than $3 trillion at specific time. There is more than 300 million cryptocurrency holders all over the world. There is more than 18,000 business accepting cryptocurrency as a payment. And Bitcoin itself has dominated more than 35% of the total market cap of the cryptocurrency. And the issue that there is 2% only of the total Bitcoin holder dominate or own more than 95% of all available Bitcoin. So, but it's undeniable that the adoption of cryptocurrency helped the growth of the economy by helping the business to find new way of payment, help the business to reach a broader customer, the easing way for movement of money from place to other place and with low cost. Also, it helped the movement of the money from developed country to the developing country. Based on all of these facts, I believe that the cryptocurrency are here to stay. No doubt we will rely deeply on the cryptocurrency, but the main issue that's the cryptocurrency need to be more regulated the same way as the bank, the same way as the other financial institutions. Unfortunately, the cryptocurrency had suffered or declined in an extreme way during 2022. It lost more than 50% of its market cap due to many factors, such as the large-scale fraud related to the cryptocurrency, the last one related to FTX, the tight monetary policy, the high interest rate, the high borrowing cost. All of these factors together negatively affected the investor perception and trust and the confidence regarding the cryptocurrencies. So the cryptocurrency in general need to be more regulated and also the central bank digital currency development will help a lot to bring more confidence regarding this type of asset.
Well, what's your thoughts on cryptos generally, Bitcoin? So, your
It depends.
good asset class?
It's not really, for me, it's more of a speculative asset. I do some speculations on it. If I want to look for some, sometimes you have some opportunities on some smaller cryptos. It's just, as I mentioned earlier, liquidity game to me. So when I see certain setups popping on liquidity or others, I could have some punch on it, and then that's it.
Okay. Anything to add, Drew, before we go to questions, perhaps?
I just think crypto's here to stay for sure, but 95% of the people that are currently doing it are not here to stay and are going to be gone, right? Simply because they approach that business either because their balance sheet's broken, and mostly, even if the balance sheet's not broken, they were losing money when crypto was much higher and had a lot more transactions. And it's very difficult as an entrepreneur to go from saying, if my revenue is projected to be down 80%, I need to take my cost down 80%. That's just inhuman to do. Most entrepreneurs can't do it, and that's why most businesses in that sector are going out of business. So I think counterparty issue is probably the biggest problem in that business.
Great, thanks guys. So let's see if there's any questions from the audience about any asset classes, any questions? Otherwise, yeah, one question here, I think.
What are your thoughts on consumables? Historically, they've relatively well on a downward market. Do you have any consumables?
Sorry, did you say consumables?
Yeah. Companies like Nestle, Otis Lifts, and so on.
That's basically food and water.
Yeah, exactly.
Defensive. If you look at the defensive sector, it usually performs like if you look at these important stuff to consume, and even you look at utilities, these sectors they tend to perform better. If you look at utilities performance last year, that's almost haven't seen any losses. Some around 1%, 2%. That was it. Well, going into 2023, if we're gonna see this a little bit of maybe twist, some are expecting a bit of twist or improvement in sentiment. The sectors that were deeply hit in 2022 could be more performing than just the sectors that were a bit on the defensive side or just suffered a little.
Great, thank you. I think that's it. Thank you, everyone.
Thank you.